Hello, everyone. Welcome to the Govern Talk on the Global Economic Storm, Frontier Economies at Crossroads. Before we get started, please silence your cell phone and other devices. At the end of the talk, we'll have a Q&A session. If you have any questions, please raise your hand. If you are chosen by the moderator, please stand up, introduce yourself, and keep your question brief. Now, let's welcome our moderator, Mr. Selassie, and the speaker, Governor Njoroge, to the stage.
Oh, yes. Okay, very good afternoon to everybody, and very warm welcome to this annual meeting's Governor's Talk. Patrick, which I'm going to be conducting with Governor Patrick Njoroge. Very happy that you accepted this talk, Patrick. Really very honored that you would do so. Patrick and I go back, some way back, it's fair to say. So it's really always very nice to see friends and colleagues in such an important position. Patrick, thanks for agreeing again, and I'm going to jump straight into the talk.
But thanks for the invitation. I'm glad to be here.
Thanks. So, somewhat crazy times we're living through. Barrage of shocks that our countries have been facing, not unique to our countries, of course, global. Just as we are emerging from the pandemic, it is causing quite a bit of pressure on frontier markets like Kenya in particular. The Russia's invasion of Ukraine, the global inflation that we saw, even preceding that, has been exacerbated. Can I ask how the economy is faring and what you as a policymaker, are doing to cope with this problematic period?
Thank you, Abebe. And again, great to be here. Great to be here. And the questions you are raising are really germane to the conversations that are taking place are in and around this building. It's true there are really three shocks that have hit us in the context of the post-COVID period. So ignore COVID, assume that's behind us. We went through that. Then, of course, you have the shock of the price shock, inflation. Never before, actually not never before, it's been a long time since we were in this space, particularly in the advanced economies, talking double-digit inflation numbers, etc. But that is affecting all of us, and in our own markets, emerging markets, we're also in the same space, meaning inflation is a significant concern, cost of living, issues, and indeed this is becoming a significant or has become a significant social issue. So that's something that policymakers cannot afford to ignore. Then you have the second element, which is the price of oil, which has really shot everything. And the third element, of course, is the markets. The financial markets have become dysfunctional. Maybe they're always dysfunctional, but the point is they've become worse. And so we've been shut out of our markets, of the capital markets. We are a capital access country, but we are unable to borrow at appropriate rates, etc. And at the same time, dysfunctionality, you see that there are huge swings, right? For instance, on yields on various bonds. I mean, the UK, for instance, just recently, their 30-year gilts at 5%. Now it's true they do have their own issues, let's put it that way. But anyway, so the markets are not functioning the way they should be. So you have three sort of tendencies that create a perfect storm for the emerging market countries. So now the last time there was such a storm, I think Noah built an ark. Yeah. So now the problem is Noah had it better than us, because with all this globalization, we need to have the elements of a solution from various places. And I think one of the things we have to do, one of the elements of the solution is, of course, stronger macroeconomic policy. We have to start with that. And so all our economies have tried I'm talking now more general emerging markets, but frontier countries as well. We have tried to produce better outcomes on the macro front. And this is on the fiscal, for instance, so things about subsidies, fuel subsidies, etc., all that. Secondly, we have gone to the safety nets that have always been there, or at least theoretically were always there. And the safety nets, IFIs, so international financial institutions. So we've gone to them and told them that's why we're here. We need to do better to provide us with some sort of increased support because the capital markets are unable to provide us with that. I think that's not working well. So that is work in progress, and I think speed is probably not something that IFIs have learned. So if we had to put them against Kipchoge, they would win. They would lose big time. So
Haile Selassie, it's a different story.
I think that's number two. He'll come in as number
continue.
2. We'll discuss this, yeah. So I think the point here is that that is an area that we need to do. We need to work with. But I think on the whole, all countries need to work together, and the advanced economies also need to provide us with additional support, either bilaterally or through the IFI. So really those are the elements, at least, of a solution. If you are NOR, it would be easier, but in this case we are not, and so we have a more complicated solution.
Thank you. So I think maybe we can unpack this a little bit. So let's start with the domestic policy response, maybe with monetary policy. Inflation, I understand, is running about 12%?
Yeah. In Kenya, it's at 9.2%.
9.2%.
Yeah.
And you've recently done a tightening of about
75 basis points. Yes.
But still, the policy rate remains a little bit below inflation rate. Now, we recognize, of course, inflation is being driven by external forces and not so much domestic forces. Tell us a little bit about how you think about calibrating the right amount of increase, where you stand still. Just what the thinking that you've gone through the last few months.
Okay. One of the things that I want to underscore is that we are data driven in our decisions, and I think this is a point that all of us in the room have to appreciate a lot more. You can have a knee-jerk reaction and sort of say where let's say the real rate should be, or where all those rules of thumbs which we learned economics 300. At the end of the day, you have to look at the data, all sorts of data, and then sort of come up with a solution based on data. So it is true. Our rate is at 9.2, but actually, if you think of that 9.2 points, 9.2%, 5.5 percentage points are driven by food. So this is food. So really, what drives inflation in Kenya predominantly is food. Then about 2.5%, 2.5 percentage points is driven by fuel. Okay. So the rest is the non-food, non-fuel. So when you think of the core inflation that was released by the US today, at I forget the point, I forget what it was like 6 point something or something. Well, we are at below 4. Actually, we are somewhere like 3.5. I think that's the number I remember, 3.4, 3.5. So even as you look at the headline number, one needs to unpack this and understand what is driving the overall, and indeed what are the policy levers to change that. Sure, there's a whole industry about what is the right number, you should monitor, etc. But that is an entire industry which we can leave for now. So from our perspective, what we are doing is we look at what is driving inflation. I've already unpacked the reasons for the overall number. But then we do understand that fuel and food are not being driven by, they are being driven by supply supply factors, and those have zero impact in terms of monetary policy. Monetary policy is not effective, but the second round effects is where we are catching it. And so our policy is geared to containing or moderating the second round effects of this inflation. So that's really the thought process. And you need to also it's important also to think about expectations. And this is something that I think we as policymakers talk a lot more about, but we don't reveal it that much. So expectations, you need to anchor the expectations of the regular people on the street so they don't freak out. So actually, they do need to see that you are in control. Mm-hmm. And if there's anything that I think we have seen that has gone really bad for ourselves as policymakers, I'm talking now generally, but we can talk specifically, is the loss of credibility of some of the leading central banks. And that, to me, is a significant cost to the system and indeed to ourselves. So going back to the point, it is important to signal that you are actually looking at the inflation numbers that the citizens are looking at and dealing with it in a particular way. So that's really the approach that we've taken.
Does the gap between your policy rate and the federal funds rate or the ECB rate, does that gap play into your reaction function? So if you expect the ECB to be increasing or when you see them increasing, do you reflect that, or you tend to be driven more by what you see in terms of the outlook for domestic inflation?
The issue there is not so much inflation. The issue there is more on the markets. So really what you have is a huge sucking sound from the EMs, right? And those that have the data, the recent months, there have been a huge outflow. Record levels. I don't remember the data at the tip of my tongue, but record outflows from our markets, EMs and frontier markets. That's really where the play is, not so much on inflation. As I say, inflation, at least in Kenya, it's food, it's fuel. We expected the price of oil to come down, but now the last week it's begun to come up again. So we are concerned there. On fuel, on food, it is more the harvests, right? There are actually 4 commodities that account for a significant element of the food inflation. And it is flour, maize, wheat, the wheat flour as well, and I forget the 4th one. So there's a harvest that is actually going on now. So if that is actually a good harvest, then you'll have better outcomes in terms of food inflation and so forth. But again, second round effects need to be dealt with appropriately. So I just want to underscore that on this difference in interest rates, the play is more on the financial markets. Right. We have a very open current account, actually the most open current account and capital account in Africa. Yeah, really.
You're measuring this how? When you say it's open?
Meaning?
Transactions.
Yeah, transactions. Yeah. So from that perspective, there's no controls. Yeah, there are no controls that you could say will
hinder out.
Yeah.
So, I was leading towards a little bit what the policy actions of the Fed, the ECB, et cetera, and what they're having, because there's been quite a bit of discussion about, the current conjuncture where you're seeing a very strong dollar, which of course has been impacting you also, but also some discussion, including in the context of the meetings, about how the Fed should be thinking about, its effects on our countries. Of course, it will be primarily driven by what it needs to do for the domestic monetary conditions. But in your view, how should advanced country central banks think about and approach the spillovers that follow from their actions?
Abe, that's the most important question that can be raised during these meetings. And I hate to differ with you. That conversation is not taking place
enough.
Enough. We need to do more of it. And I do hope by Saturday there'll be a lot more of this. I do hope that in the various communiques this will be let's say, reflected.
This is your chance to inject that.
Well, I'm not sure. But anyway, I'll say what it is, at least from my perspective. It is through the the authorities, monetary, fiscal authorities, their primary responsibility is their own jurisdictions, things in their own jurisdictions, but they also have to look at all data. And what is happening is, for instance, with a very strong dollar, due to the policies of the US, right? It is actually hurting our markets, yeah, EMs and frontier markets. So the point is that the authorities need to consider, this is now, let's say, the American authorities or the ECB, so the Fed, ECB, and other leading central banks, they need to consider the spillovers into our markets. Not only because of the first order questions of, for instance, think about growth, right? Because this will impact on growth in our countries, etc. But actually, worst of all is not growth. The worst of all is if there's a financial accident in our jurisdictions. Now we say, well, okay, fine. We've never had an accident in a long while. But, I would ask colleagues to go back to 1982, the Mexico crisis, right? It was in Mexico. It was not in the US. But the world indeed realized, and in that case, maybe the world was around the Potomac, for all I know. I don't know which geography that is, but whatever it is, actually the Fed was the first one to actually move ahead and try and insulate this problem, to isolate it and insulate the rest of the let's say, global system. And indeed, the IMF came in, etc. So I'm making the point that the cost of a financial accident, particularly now, maybe to go back a bit, Michel Camdessou, former MD, he said that the first crisis of the 21st century was the Mexico crisis. And actually, he's right. I mean,
82 or 95?
Actually, it was 95. Yeah. 95. Yeah, 95.
Yeah.
But the point is, he was wrong, I think, in that, or rather, there's one element that was much more dynamic. Meaning the crisis in 95 was actually slow in the way it works, right? Today now, if you have a crisis, it transmits like that. You saw what happened in the UK, and all of us were hurt by what happened in the UK. Meaning, actually, you look at our bond yields, they shot up. I mean, for them, they were shot up by 20 to 50 basis points. Ours shot up by 500 basis points. 500. That's significant. So I'm just making the point that they have to incorporate the risk of those sort of accidents, and indeed the impact through the let's say the spillbacks, as we call them, on the repercussions back to the advanced economies. Secondly, which is very important, even as they incorporate this, and therefore take a particular view about how quickly they would raise rates to deal with the inflation problem. Inflation has to be dealt with. There's no doubt about that. I think the second element is that they also need to use their might or their voice in institutions such as the IMF, World Bank, the so-called traditional safety nets that we have, so that we in the EMs and advanced frontier economies can actually get more support and thereby minimize the need for significant adjustment, forced adjustment one way or the other in those countries. And I think that is extremely important. And this is why we are here, really, in Washington at this time. So those are the two directions I would want to put on the table.
Maybe this is a good time to segue into what you would like to see more, the IMF doing more. Huh? I mean, what you're highlighting is the exogeneity of a lot of the root causes of the challenge that our countries are facing at the moment, and the need, I guess, for an international social contract. That there ought to be one. It should be stronger response from entities like ours. So if you could say a little bit about what the IMF could do more to help you at the moment?
I think first and foremost is additional resources, direct, let's say, we in Kenya have a program, an IMF program, which has been very successful in terms of achieving the specific objectives. The reason for having the IMF program for us was more of, let's say, a seal of approval in terms of quality, etc. We had it straddling the election periods that we had in August. So it's, I think, 38 months long. But at the same time, of course, the quality of the policies. But the key objective was that it was going to be a revenue-driven consolidation or fiscal consolidation that will put the debt path on a sustainable downward trend. So that's really the basic point. So from our perspective, when you do these programs, you actually program in some resources, etc. But then we didn't get all these external resources that we were hoping to get. I'm talking of from the markets, right? So what we would need to do is to have at least a significant additional inflows, so an augmentation, as it were. Now that will help us right away, right? But I think in some sense, the fund should also be forward-looking and actually immediately begin thinking about this problem will recur again and again and again. Why? Because that's how the shocks are coming. Yeah. I mean, again, going back to Noah, I mean, the poor man knew that it is only one flood, and then he's okay. I think he did know that, yeah. Now, from our perspective, we are not him, so we know we'll be getting these shocks every now and then. I mean, just to show you the sort of shocks we are getting in Kenya, the last 4 rains have failed. Last 4. Agriculture is rain-fed. Now you think of even the food crisis, right? I think it's United Nations Economic Commission of Africa says that about 345 million people in Africa, in the world, actually are danger of starvation. 40 million of those are actually in the Eastern African sort of geography. That's significant. So I think immediately the idea of ensuring that there's an increase in access, doubling, tripling of the levels, and particularly because the other side of the IMF, or rather the way IMF looks at its theology, it's one of good policy. So there's conditionality. So if you are doing good policies, if actually you've done very well, for instance, our program, in my mind, has been exemplary in terms of performance. So why is it that we are doing drip feeding, you know? I mean, that is the issue. So I think the advanced economies, I mean, they have resources that maybe they are less, well, it's not really so much of an issue for them, you know? You could think of the SDR resources. Maybe they shouldn't put it in the IMF as their let's say, their share as such. Maybe it should be, we should work out some other arrangement, some loan from the tier 2 capital, if you want to think of it that way. But anyway, so I think the people in the room and in the IMF, there are many young minds that can do good financial engineering. But a doubling, tripling of access, I think, is something that should be put on the table.
You don't worry about the credit risk side of the argument? You're a good banker.
I don't worry about it, but I consider it. And this is why I said, you know, again, at the end of the day, credit risk, it is really about what you do, right? It's about credibility. We started off on this issue of credibility, right? I talked about the certain central banks that have lost credibility. So it's something that can be dealt with, and you can measure it in terms of figuring out how much credit risk you're running, etc. But I think those things can be dealt with. I don't think the issue today is credit risk. The issue today is where will we be in 6 months' time? Where will these 345 million people be? Where will our economies be? Will we have had an accident? I would hate to be here in April next year, and we are talking about 3 or 4, we're not talking just about Ukraine, we are talking about 3 or 4 other countries where we've had a significant financial accident. That would be significant.
Fair point. You touched on the difficulty that climatic change, changes in the climate is causing the Horn, but also other countries in the region. Tell me a little bit about how you as a central banker are thinking about this issue. I know you think quite a bit about agriculture, for example. I know it's a passion of yours. But more formally, in terms of your day job, how does it influence how you think about these increasingly frequent shocks and how they affect?
That's a good question. I think it applies not just for us, but for most other people. Basically, climate change should be front and center of everything that we do. It shouldn't be sort of an add-on on the side. Now we are talking about not just financing, but think of the regular work that any commercial bank does. Is there an element there of sustainable financing? Or is it sort of same old, ROE, return of equity, or return on investment, those sort of considerations. So in our jurisdiction in Kenya, all banks signed up to the Sustainable Finance Initiative back in 2015. I think it was November of 2015. And it really urged them, and there's a framework to consider this second dimension of sustainability, right? We have also now given guidance on consideration of risk in climate risk. And the banks are incorporating this into the way they do things. But that is not sufficient for sure. It has to be that all of us need to take a lot of action to mitigate and indeed adapt to the new sort of, or to the consideration of the risks that are coming in. I think we've talked enough in the various fora about is it 1.5 degrees and all those. At the end of the day, we have to do the work that is needed. Now, it is true, from our perspective, Africa is not the largest polluter, right? We contribute less than 5% of global emissions, right? East Africa may be less than 2%, 1.8. So nothing really, negligible. Maybe that's just from the Potomac, if you ask me, So, by the way, I used to run on by the Potomac, so
which is why you're
and I did that the other day. So it's great, great memories. But anyway, so the issue of dealing with the mitigation, etc., is significant. Okay. It is true. People then tell us you need to do ESG, etc., etc. I don't know if that is. My point would be fine, but we are not the problem. First, talk to the large polluters. Let them look at a mirror and talk to that guy there. Yeah, let them do what they claim we should do. But it's true, ESG should be a significant element, but to me it should be part of the main, not just something that is secondary. And I think a lot of our banks are in this direction. But I think we have to appreciate that the largest costs are to us. Maybe we are not the largest polluters, but I think it is important to acknowledge that if we do nothing in the advanced economies, the large polluters, it won't matter what happens in Africa or in Kenya or in that district, wherever it is, because they are nothing, but the pain is there.
Of course.
Yes.
No, what I was getting at was, do you build in your normal assumption, if you're having 4 years out of which 4 out of 5 are drought kind of years, do you from now on revise your model and think, okay, the frequency of these shocks is going to be so high, as a result I'm going to be thinking that, how do you think about it?
I understand what you're asking.
Does it mean that you want to build buffers, or you want to be more aggressive in addressing things up front?
I think the first is that you have to build buffers. There's no doubt about it. And frankly, if you go back to COVID, we came into COVID with significant buffers. And that's really what saved us. Particularly even though there was a lot of conversations about what the IFIs did, etc. But the first element there was the buffers that we had. So I don't think there's any other way, there's any way of going around that. You have to have some buffers with you, both in fiscal and also more generally the other buffers. So that's one. But I think the other thing of projecting, having a scenario, of course, the baseline will be less aggressive, or rather less favorable. Mm-hmm. But I think you do have to have other scenarios that are sort of negative, really. But I think at the moment, my question is, where are we going to be in 5 years? You don't need too much. I mean, you can actually plan it out 3 years and figure out where you're going to be. I think it's a very tight 1 year. Yeah, I talked about 6 months. I don't know if I should have a scenario for 6 months, but all I can say is it's quite dark out there.
Period of difficulties, yes, and a lot of uncertainty.
But I think, just to finish on my part, I think one of the unsung heroes in all this, frankly, are the policymakers. Because there's a lot of the fiscal, for instance, I have a lot of respect for a lot of fiscal authorities that, they end up doing some sort of magic in, balancing all these things. But I think all the policymakers, and to me, that should be acknowledged. Of course, the population, but I think first and foremost, the policymakers.
Patrick, as always, fascinating talking to you. Thank you so much. Governor Patrick Njoroge of the Central Bank of Kenya.
Thank you. Thank you, Abebe. Delighted to be here. Yeah. Now we should go out and do a marathon or something, right?